Hello everybody, welcome to this monthly webinar snippet. So I will take you through our product performance followed with the market updates and what is the market outlook going forward. So to begin with, we will start with the product performance. The last month has been sort of a strong month for the indices, and the market continues to remain little volatile, but ended on a positive note. All our schemes did reasonably okay compared to the benchmark. Particularly, the 10x portfolio did reasonable, but others obviously had a relatively tough time given the fact that our stocks didn't do as much as the index did. We will, but from a 1 year, 3 year perspective, most of our funds are doing very well, and the alpha generation, particularly in the emerging giants and the 10x, continues to be very strong. We believe that over the next few months, given that we are entering into a phase of election, particularly led by global developments, we might see markets being a little sort of volatile compared to the last 5-6 months of strong performance on a upside. Moving from performance to our thought process on how do we perceive the market capitalization would be. So over the last 5-6 months, mid and small cap have participated and run up stupendously. In fact, large cap have actually not done anything compared to the mid and small cap names. So in our assessment, this is a good opportunity to increase exposure into large cap names, given for two reasons. One, the earnings growth of this particular category has been strong, and B, the companies who have delivered these earnings growth have not very well rewarded by the markets. In fact, we believe majority of this particular underperformance is a function of just liquidity attractiveness towards this mid and small cap names, which could reverse very quickly and subsequently impact the performance. If you look at the coffee can portfolio, majority of the stocks are actually trading below 5-year and 10-year averages, and we believe this is once a decade opportunity to increase allocation into coffee can and the names in the large cap in particular. In fact, from a 1 year forward perspective, Nifty is around the long-term averages, but lot of stocks in the portfolio are below long-term averages, thus providing a fantastic opportunity to hop onto. Importantly, the growth of the portfolio in the last decade has not only done exceptionally well, but has consistently higher compared to the Nifty by 500 to 1000 basis point on a regular basis. Importantly, the multiples of the portfolio also is lower compared to last 2.5 years, primarily coinciding with the global correction in the interest rate cycle. Importantly, the portfolio companies are not only delivering strong earnings growth, but obviously have a superior return profile, as much as 2x the index in the last decade on an average. So our portfolio ROC is somewhere around 35-36% versus the index of around 15 to 17%. From moving on, so this is a quick update on our opinion on the large caps. From moving on to how we are perceiving on the economic update, we believe the economy continues to remain on a strong footing. Collection and GST, either you talk about the PMI levels or you talk about the inflationary, all is trending towards a healthy economic update. Importantly, the recent RBI meet also maintained its status quo on the interest rate, which basically means they will be very, very data driven and will be looking forward for other inflationary parameters before taking any further decisions on the interest rate. From moving on to economic to how the corporates will behave, the Q2 earnings growth in our assessment will be strong with the 23 to 25% EBITDA growth and 7 to 9% revenue growth for the Nifty companies. Growth again this time will be driven by auto and auto and banking names in the particular in that order, and commodities will continue to remain sluggish. One of the most important milestones that happened over the last few days is India market bond, inclusion into global bond index. This is particularly very enticing given the fact that This was being discussed for almost now 3.5 years. The timing of the inclusion is also very, I would say, conducive for the India. A, because not only it brings India from a global stature point of view, but the kind of inflows this particular event can have is quite significant. We assume that over a period of 12 months time frame, this particular inclusion can lead to $25 billion worth of inflows, which is a fantastic news from a from funding the CAD perspective, and also will act as a support in case commodity prices shoot up further. Moving to what's happening in India versus from a global point of view, because for global investors, India bond yield and the risk-free rate will remain an important element before they invest into Indian GSEC. So we believe the narrowing of the US and India 10-year yield is probably come to a fag end, and going forward the differential could only rise further, primarily because US is coming at the fag end of raising interest rates, and India will maintain its fine balance between growth as well as inflation. So we believe this is obviously, this particular inclusion brings great opportunity from a global investor to invest in the country, but also the differential enhancement will accelerate that investment beginning next calendar year. With that, thank you very much, and I will conclude this particular session.